Billionaires don't pay their fair share in taxes. ProPublica just came out with an investigative report, an expose about how billionaires get away with not paying money in taxes. I'm Bridget Sullivan Mermal, and I've got a fee-only financial planning practice in Chicago, Illinois.
And I'm John Shear. I have a fee-only financial planning practice in Middleton, Wisconsin. And on today's episode of Friends Talk Financial Planning, we're going to talk about that article and how some of those techniques might apply to you. And Bridget, I've read a little bit about it, like kind of just enough to be dangerous. I know you've kind of dug into this a little bit, and it's interesting. I'm interested to hear what you found out about and this article in general. And I'll tell you, it's interesting that. And not to get into a policy or ethics, or I read these articles and it's like, how can I apply these things? Like, is there anything I can steal from these techniques and use it for the regular people that I work with?
Right.
And that's the one thing when it talks about not paying their fair share, that's a judgment call. We can talk about that at a later time, right? But it's like, here are the rules, right? The rules are written, and then I look at how can I take advantage for my clients? And I'm interested to hear what you found in some of your research on this, and maybe some techniques that we can use with our clients.
Yeah, well, let's talk about the rules that they're exploiting to not pay their fair their fair share. So basically, how they're gaming the system. First, low W-2s. So have the billionaire, their W-2 doesn't say a billion. It says 80,000 in one example. So they're making the same amount as their employees. So the next thing.
And when we're talking, let me jump in. W-2 is we're talking like the salary that you get, like your paycheck every 2 weeks. They keep that lower, and he was stock or other things. Okay, got it.
To pay themselves.
Yeah.
And then they exploit Roth IRAs. That's another tool. They also exploit charity distributions. So they send out private foundations for their charities. And last but not least, they don't realize capital gains. So they have, maybe they've made a lot of money on their stock of their company. They bought it when it was a private company with stock options, and then the company goes public and the price goes way up. And so all of those gains, they don't realize them. So that means they don't sell the stock. And that what they do is they need money, is go get a loan based from banks or their brokerage house. They get a loan on that is secured by the value of this stock. And that's what they do. And there's nothing, that's a technique that's an age-old technique. That's not like that's anything scandalous from my point of view.
So let me just start. Was that I heard four things. One was keeping salaries low, right? Another one was taking advantage of charitable donations and how you exploit some of the things that are around that. And then Roth IRAs, techniques with Roth.
There's a whole separate article about the Roth.
Yeah. And then that last one then was, deferring gains, not realizing capital gains by meaning not selling things if you don't have to.
Right.
And if I heard, so the detail, just a brief overview, we can't dig into all these, but if you have things that have appreciated, not selling it necessarily if you don't have to, but maybe using it as collateral, like that. If you have a piece of property that does, and you can take out a mortgage on it, a similar thought process for that fourth one.
Yeah, exactly. So if you have investments, as you have stocks in a bank or in your brokerage account, you can get a loan that is secured, or the loan comes after those securities if you can't pay the loan. So that's what is the underlying security in the on the loan. Similar to if you have a mortgage, what secures the mortgage is the value of your house. Or if you have a car loan, what secures the car loan is the value of the car. So if you can't pay for the car, you get the repo man, they take your car. So if you can't pay for the loan on these stocks, then they take these stocks.
Got Got it. And so that, and it's interesting hearing that those are some techniques that we've used. I don't know if maybe probably common from a professional standpoint, and that's one that's out there with Roth. Again, we don't want to dig too deep into, but with the Roth IRA and some of the, the strategies with that, it seems to me that it would be buying things. I mean, what we do for clients, buying things that have really high growth potential, because then we can forgive and there's no taxes on the other end. Is that, I mean, effectively what's being done by these billionaires?
Well, that is a supercharged technique that they're using. They're somehow getting buying options in the Roth that the companies are issuing, and so that was and they named a specific place that they used to use this technique. So I'm not saying that what they were doing was illegal, but that's not available to. I have not seen that widely available whatsoever.
But I wonder, because a regular person can buy options, not those kind of special options, right? But are there some things that with our clients, I know we look at doing some of those that might be worth digging into on as I think about
You're
it
interested
from a professional standpoint.
Yeah, right,
And
exactly.
can you tell me a little bit? And it's interesting hearing these things like keeping wages low if we can for business owners. Those are techniques we'll use, and using deferring capital gains, right? Those are techniques we use with our regular clients, not not the billionaires, and using tax advantaged investing and trying to maximize that, right? Like not fancy. Yeah, there's some things these people on the fringes do, but that's some of these are really applicable to real life. What about the charitable one? Can you talk just briefly about when you talk about exploiting charities, like what types of things are those billionaires doing? And does any of it correlate with what regular people can do?
Well, it correlates quite one-on-one. It definitely correlates to what regular people can do. So they didn't outline it specifically in the article, but from what I gather, wealthy people transfer some of this appreciated stock, right? Like that they've got into a charitable foundation. They get a tax deduction for that when they do that.
Yeah.
And then they have this charitable foundation that they can hire people at the foundation, and they can do what they want with the foundation. Now, this foundation, as we know from other stories, are subject to rules, et cetera. But regular people, what they can do is either donor advised funds. So that's the same concept as taking appreciated stock and moving it into a donor advised fund, where you can control, you get the deduction when you move the money over, and then you can distribute it at your leisure. And another technique that we use with people is donating part of the required minimum distribution from their IRAs. So that's maxed out at $100,000 a year. So they didn't talk about that.
Yeah. But
I'd admit that the billionaires do the 100 grand a year.
But it seems like those things really tie in because as I was saying, the same thing you just said, well, we do that. We call donor advised funds mini foundations because it's kind of how they work, right? Like for the concept. And so maybe to circle back, one thing I think it's really interesting that when I read these articles like this and when you do, it's interesting from a different standpoint, but looking at, okay, what applies there? And what I heard, the takeaways are, keeping wages low, using those Roth IRAs, taking advantage of the charitable giving, and deferring gains on your investments. Like that's all stuff that we're doing for clients and that regular people can do. Of course, a different scale, right? If I've got $100,000 versus $100 million, right? There's different dollars, but these are the techniques that those rich folks are using that regular people can use in their lives, right?
Right. Exactly. That's true. And if they change the tax law, and probably, you can see that the current tax law is producing these results. And I think a lot of people are outraged by these results. Then changing the tax law is going to, change some of the incentives and change the results we get. But I bet that the rich people and people that have been able to save or have even moderate amounts of wealth are going to still benefit from looking at the tax law and saying, what can I do to save money in taxes?
That's great. Well, I think that's a great place to wrap up, is take a look at those 4 items, and maybe we'll do some future episodes to dig into some of those deeper. It's nice to have the concept, but maybe we can get some more depth on those 4 topics. And as we wrap up, the number one action step, we like to take some action steps, is to make sure to subscribe to Friends Talk Financial Planning. That helps us rise in the ratings and helps other people find this sort of information. So please do that. And then the other item is that Bridget and I are both members of the Alliance of Comprehensive Planners. ACP is a group of fee-only holistic financial planners across the country, and you can find out more about people who think like us by going to acplanners.org.
Great. And so with that, I'll wrap it up. Thanks,
All right.
John.
Yeah, thanks, Bridget.